with regards to retail traders, we often feel like the institutions, we don't know who they are, what's behind the curtain, and we just feel they have a lot more information, a lot more resources, and we feel like we get left behind. Is that something that is real, or do we all have access to the same at the end of the day?
Look, institutions will spend millions of dollars in gathering data and crunching the numbers on that data. So by definition, they will have more resources. However, the most fascinating thing about the rally that we have seen over the last 6 weeks has been that institutions have actually sat more on the sidelines than they have been invested.
Wow.
So we measure things, we look at things like positioning metrics for institutions. Deutsche Bank publishes one that you can Google online, you can pull it up. It usually is lagging, so it'll be a little bit delayed. Goldman Sachs publishes one as well. You can look up Goldman Sachs positioning indicator. And what you see on those is that even as the market was rallying, institutional investors were staying underweight equities, which meant that they are still, or means that they are still being drawn and pulled into this market, which is why we've been saying that the pain trade is still higher for the market, because if you're sitting on the sidelines and you're underinvested and you just saw a 20.25% rally from the closing low, you have to get back into this market. And it's even amplified even more when you cross over certain things like the 200-day moving average. It was a really important resistance level. That then causes more buying because the systematic buyers have to buy once you cross over certain levels. And the shorts. And so what we saw on Monday is Goldman Sachs came out and said, you've actually seen a record amount of short covering. So yes, institutions might have a lot of knowledge, but that doesn't mean that they get every move right.
Mm-hmm. It seems institutions are relying a lot on indicators, which in the retail realm is something is more, we frown upon it in the sense of they're a bit lagging and they're not as precise in terms of pinpoint entries. Do you think that's a fickle endeavor to try and get pinpoint entries, short stop losses, rather go for bigger plays, fundamentally driven, and larger risk parameters?
Do you want to take this one?
Absolutely. I'll take it. Well, you have to realize that the retail traders are still think this is a get-rich-quick scheme. They are online listening to people on Twitter, Uncle Herbie on the internet, signal services telling them what to buy, FOMO, trading on hype, hope, FOMO. These are not sustainable trading strategies. At the end of the day, I'm a firm believer that people who are doing it, following the rules, learning about consistency and discipline and technical analysis, who are successful at it, are not complaining about the institutions no more than them, or that the big guy is out to get them. It's those people who are not following the rules, who are treating this like it's some kind of a gamble game, and they're losing money. They're blowing up trading accounts. They love to blame someone. They don't. I see it with my retail trading community. They love to trade the market maker. They think the market maker sees their stop orders and he takes the stock down to the stop, takes them out on their stop, and rallies it. They love to blame everyone but themselves from having done the work that it takes. This is not an easy game here. It takes work to learn how to do it correctly. Imagine how much Cameron knows, and Dan, I listened to both of them. The amount of knowledge they have and that goes into their decision making is incredible.